Hey, it's Tom here and welcome back to the channel. Well, there is a lot of FOMO happening in the stock market right now. FOMO, if you don't know, is fear of missing out, and that is hugely applicable to a lot of particular stocks and cryptocurrencies and all sorts of different asset classes at the moment. There's a lot of people making a huge amount of money taking extreme levels of risk and really speculating to their heart's content. And there's a lot of long-term investors that are kind of seeing this go on and seeing people that don't follow a long-term investing strategy necessarily make a whole lot more money than them, and they're sort of wondering, should I be maybe taking some of my long-term investments and putting it into these more interesting, higher risk kind of things so that I don't miss out on all these gains that everyone else is capturing. And in this video, I want to talk about the topic of FOMO and fear of missing out, because I think it is quite an important thing to have a bit of a handle on and have a kind of game plan to try and avoid, I guess. And I want to basically go back and look at a couple of different data points. So the first thing I want to look at is what have been the things that investors have potentially missed out on over the last 20 years. So what are the best performing stocks of the past 2 decades? And then let's compare that against, say, the greatest investor of all time, Warren Buffett, and see whether he was smart enough to buy into some of these 10 best performing stocks of the last 2 decades, and how has that impacted his performance. And one of the core takeaways that I hope people get from this video is that you really shouldn't have a fear of missing out, because missing out is not the end of the world. As I will show you very shortly, Warren Buffett actually did buy some of these best performing stocks of the last 2 decades, but he by no means bought all of them, and he was kind of late to the party on a couple of them as well. And still he has a phenomenal market-beating track record over the past 20 years. So let's get into that. I do hope you enjoy the video. If you do, please hit like and hit subscribe. It does help me out and support the channel quite substantially, so I would appreciate that. But for now, let's get right into the video. Okay, so I will put up on the screen here the best performing stocks of the past 2 decades. Now, the article I'm pulling from is actually a couple of years old now. This was written in 2019, but my understanding is that their results would largely be unchanged. Many of these stocks have still continued to do very, very well since the writing of this article. So let's just go straight from the top. So the best performing stock since the year 2000 is Monster Beverage. If you had invested in that stock in the year 2000, you would have been up about 62,000% as of when this article was written, which is just mind-blowing, ridiculous return. Many multiples of your money over and over again. You could have put in a relatively small sum and probably been a millionaire with Monster Beverage, and that's the same with a lot of these businesses as we go down the list here. So at number 1 is Monster Beverage. Number 2 is Netflix, about 23,000% since 2000. Equinix, 12,000%. Tractor Supply Company, about 10,000%. Intuitive Surgical, about 9,000%. Ansys, about 7,800%. Apple, about 7,400%, IDEX Labs, about 6,800%, MasterCard, 6,200%, and Ross Stores, right about 6,000% return since the year 2000. So absolutely mind-blowing returns. And what I want to do next is basically compare this list of 10 stocks against Warren Buffett's current portfolio. Warren Buffett is the greatest of all time, so surely if anyone is going to be able to pick these individual companies, it's got to be Warren Buffett, right? So let's jump over to Berkshire Hathaway's 13F filing, which discloses all of his US stock positions, and let's see how many of these show up in his actual portfolio. Okay, and we might as well start with the big dog being Apple, because it's pretty well known at this point that Apple is Warren Buffett's largest investment, and it is one of the 10, and it's one that he's had a massive home run on in terms of his investment return. But I think there's a couple of really, really important things to note with Warren Buffett's Apple investment. Now, the first thing is really the timing of it. So we were just looking at the performance from the year 2000 through to about 2019, and we saw that Apple has had many thousands of % return, just an absolute home run. And Warren Buffett has had a pretty stellar return from Apple as well, as you can probably imagine. So adjusted for stock splits and everything, Warren Buffett paid about $37.32 per share for Apple, and those same shares are now worth about $122.15. At least they were at the end of the quarter when this last 13F came out. So absolute home run for Warren Buffett, and he's captured about a 3x or so on that particular investment. But that is nowhere near the thousands of percent return that you would have captured if you had invested in the year 2000. So Warren Buffett did in fact miss out on several years of investment return. He actually only bought Apple, or started buying Apple, in the first quarter of 2016, and missed out on literally 16 years of monstrous gains up until that point. But even after missing out, he has still captured an absolute home run of a return and done very, very well for himself. Now, as we continue down the list of some of these top performing stocks, so Monster Beverage, Netflix, Equinix, Tractor Supply Company, Intuitive Surgical, Ansys, we've already talked about Apple, IDEX Labs, MasterCard, and Ross Stores, there's actually only one other stock in that list of the top 10 that actually shows up in Warren Buffett's portfolio. So even the greatest investor of all time was not able to pick all 10 of these. He was in fact only able to pick 2, and the second one is actually MasterCard. And I barely even want to actually count MasterCard as a successful pick for Warren Buffett, just because of the size of it in the portfolio. So if we jump over to, again, the 13F filing for Berkshire Hathaway, we see that MasterCard is way, way down the list in terms of where it fits in his portfolio. It's a very, very small position, even though he's got an absolutely huge return on it. So with MasterCard, we'll see that Berkshire Hathaway owns about 4.5 million shares, worth about $1.6 billion. That's the current position size. But if we scroll across in Well Wisdom and have a look at the price that he paid for those MasterCard shares, he paid about $22 per share, and it's been hugely successful, and the share price is now more like about $360. So he's gone from about 22 to 360. Enormous return, but he really didn't do it at any sort of scale. So if you run the maths on it and look at those 4.5 million shares and the average price of about $22, you can figure out that Warren Buffett put about $100 million into MasterCard at the time. And when I say at the time, this was back in 2011. So in 2011, he put about $100 million into MasterCard. And if we compare that against Berkshire Hathaway's market cap at the time, Berkshire Hathaway was about a $200 billion business in 2011. So this was really not a big bet for Warren Buffett. If you run the maths, $100 million out of a $200 billion business, he put about 0.05% of the portfolio, if you look at it on that basis, into MasterCard. So although he's really got 2 on the list, one of them being MasterCard, I don't really particularly want to count, because to a large extent he still did miss out on many of the gains. He did not make it a big position like he often likes to. And he did capture Apple, but he was about 16 years late to the party with that one. So surely you would think that if Warren Buffett has really missed out on a huge percentage of these big, top 10 performers, and he's only captured 2 of them, and really he's only captured about 0.5 of one of them, because he's really got one in size and he was kind of late with investing in it. You would think that Warren Buffett's track record is probably not that good, and you would be very, very wrong in thinking that. So if we look at the returns from Berkshire Hathaway Class A shares, again, with Berkshire, you can sort of cherry pick, honestly, whatever time period you want. If you want to show that Buffett has underperformed the market in recent years, you can pick a shorter time frame and do that. But if you want to show that Warren Buffett has performed really well for a long period of time, you'd probably go back to 1965 or whatever. I see a lot of people kind of just cherry pick particular time periods, but for consistency, I'm going to give you the period of time from when we were talking about these stocks performing really well. So from 2000 through to today. So if you look at the returns from Berkshire Hathaway, the Class A shares are up about 670%, which is a very good return in anyone's book. If you compare that to the S&P 500, the S&P 500 is up a little under 200% if you just look on a simple kind of price chart. But of course, the S&P 500 also pays dividends. So if you factor in those dividends, the S&P 500 is up about 330% or so as of recording this video. So even after missing out on pretty much all of those top 10 best performers in the stock market, Berkshire Hathaway has still managed to return about 670% to its shareholders versus about 330% from the S&P 500. So it really goes to show that missing out on some of these huge home runs and massive winners that a lot of newer investors taking a lot of risk are starting to see in their portfolio at the moment, you can still have a really good track record if you don't even touch some of those positions, or if you really don't touch any of them. And I think there's a couple of really good reasons for that. Oftentimes with these high-flying stocks, you're paying very, very high valuations, and we know that that is something that Warren Buffett does not like to do, because the valuation that you pay when you invest in a business is a pretty significant driver of your returns going forward. And also many of these high-flying hot stocks, frankly, are bubbles, and they pop eventually. And it means that although some people do really well from these investments, a lot of people on the back end really lose a lot of money. And if you've been following Warren Buffett for any extended period of time, you will know that Warren Buffett's first rule of investing is don't lose money, and his second rule of investing is don't forget the first rule. So really, these types of investments or speculations do not fit Warren Buffett's strategy. And I think a huge chunk of the reason why Warren Buffett has been successful over a very long period of time is not really the fact that he's had these huge home runs in Apple or Coca-Cola or American Express over the years. Of course, those have helped a lot. But what has really caused him to outperform the market over a period of time is having an intense focus on downside protection and in not losing money. And if you look over those past 20 years at Berkshire's performance track record versus the S&P 500, you'll actually notice that the period of time where Berkshire beat the S&P 500 the most dramatically was actually in those very early years of the 2000s. Just on the back end of the tech bubble had just burst. You'd gone through a recession in 2001 and 2002. And 1999, 2000 leading into that dot-com boom and bust is a period of time that people are seeing a lot of similarities with kind of what's happening today. We're seeing a lot of technology stocks do really well. We're seeing a lot of new investors get into the market, and we're seeing a lot of speculation and margin and a lot of people taking on debt to invest significant amounts of money. And it really just has set up the potential, at least, for something kind of scary to happen on the back end of all of this. And Warren Buffett back in 2000 really steered completely clear of technology stocks. At the time, people were telling Warren Buffett he had no idea what he was doing anymore. If you go back and watch some of the Berkshire Hathaway annual meetings from around that time, from the 99 to 2000 kind of time period, you will literally see people get up at the Berkshire Hathaway meeting and tell Warren Buffett he should be investing in tech stocks, maybe even just put a little bit of the portfolio in there. And, you know, they talk about how their tech shares have doubled versus what their Berkshire Hathaway shares have not done that well. And they've sold their Berkshire Hathaway shares to invest in tech businesses. You know, there were people literally getting up and saying this stuff at Berkshire Hathaway annual meetings, which is just crazy to look back on now after seeing what happened from the dot-com bust in the early 2000s. But it just goes to show that people go through these periods of, you know, this fear of missing out and seeing their neighbors make money when they're not. And it just kind of creates some really wild pricing and fluctuations in markets. So that's some of my thoughts on FOMO, on fear of missing out. Really, you shouldn't have a fear of missing out, because missing out is par for the course, and it will happen, and you can miss out plenty and still have a phenomenal track record, as the track record with something like Berkshire Hathaway shows very, very clearly. So I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.